Hi, everybody. Thanks for joining me. Before we get started, please click subscribe to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, I'm going to be doing a little bit of shopping in the market at the end of the year. I recently did a video of a couple of stocks I plan on selling, and I'm trying to get some extra retirement contributions in before the end of the year. So, I'm going to end up with a nice little stockpile of cash on the sidelines that I could put to work. Some of it I'm going to use to buy positions I already have, some of my favorite stocks that I've talked about in other videos. But I am going to take the opportunity to add two of the favorite dividend stocks that I've been watching, but don't own just yet. So the first one is a company called Vici Properties. Ticker symbol is VICI. This is a real estate investment trust, which shouldn't come as a surprise if you've seen my other videos. It's a real estate investment trust that specializes in the gaming industry. Vici was spun out of Caesars Entertainment a few years ago, and it recently has been in kind of an aggressive growth mode. It acquired its MGM spun off counterpart, MGM Growth Properties, earlier this year. It acquired the Venetian and surrounding properties in Las Vegas uh, earlier this year, which between those two made it the largest landowner on the Las Vegas Strip. It owns a total of 43 properties in Las Vegas and in regional gaming areas. The properties combined to produce about $2.6 billion of annual rent. And one of the really cool features of Vici is its lease structure. Now, it's common for commercial leases to be very long in duration, and that's just true in Vici's case. Some of its leases are 30 or 40 years in length. But one of the unique features is most of its leases are inflation protected, which is really interesting as an investor right now. Currently, about half of its leases have some component of them that are pegged to the CPI, meaning if inflation's high, rent goes up accordingly. By 2035, based on Beachy's current lease structures, by 2035, nearly all 96% of its leases will be tied to inflation. So it's a lot of real estate investment trusts, their leases have, 1 to 2% annual escalators that are kind of set in stone. So if inflation's really high, they lose out. Not the case here. I think the gaming market still has a lot of room to grow. There's definitely a trend toward legalized gaming throughout the United States. And I love that they're kind of in aggressive growth mode while still maintaining a really responsible balance sheet. It's really showing in the company's efficiency as they add more new acquisitions. And the company has a 4.6% dividend yield right now that is well covered by its profits. So this is not a risky stock, despite what you might think about the gaming industry. This is a slow and steady rent machine. So that's number one. Number two is a company called EastGroup Properties, ticker symbol EGP. I don't have any exposure in my portfolio to industrial real estate, and I really should. E-commerce is a major trend. It only makes up about 15% of US retail right now, and that has steadily grown for a long time. E-commerce needs a lot more fulfillment space than brick and mortar retail. Um, that's a great catalyst long term for companies like EastGroup. Short term, there's a lot of oversupply worries, which is why the stock is down by about 33% from the highs. Um, with any hot sector of real estate like industrial has been over the past year or so, there's always the risk that they're building new properties too fast and demand won't be able to absorb them quickly. That very well may be the case, but I see that as more of a short-term headwind, not a long-term thesis buster. I think East Group is very well positioned to grow over the long run because of its Sunbelt focus. Its top markets are places like Florida, Texas, Arizona. These are places with positive net migration and some of the hottest job and wage growth in the United States. So it's not exactly a high yield stock. Its dividend yield's about 3.2% right now, still above the average. So qualifies as a high dividend stock. Um, but it has a lot of upside potential in the stock price as well as its dividend. So those are two that I plan to buy and add to my own portfolio by the end of this year, and hope you enjoyed. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.